Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Michael Kelly. He's a global head of multi-asset at PineBridge Investments to discuss what asset classes could potentially be the beneficiaries of a global recession. Michael, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill.
And let's discuss that even before we get into the asset classes. What's your base case for 2023?
It has moved from recession for sure to with China reopening, that changes a lot. And with the warm winter in Europe, that changes a medium amount. So probably a soft recession, but the biggest issue is not, we don't buy or sell GDP.
Right.
The biggest issue is we think we'll have a normal profit decline as if it were a recession without a recession.
So with equities, are they the most attractive, or has that TINA, there is no other alternative moment passed? Which asset class do you think is going to stand out?
Well, there are alternatives. You know, last year, every asset class did poorly at the same time because we had this reset of the real interest rate from very negative to just barely positive. Massive valuation shift on every single asset class at the same time. So they're all, in much better shape than they were before, but fixed income probably has had, the bigger reset because, again, the cost of money, cash was trash because central banks made it trash by making it uneconomic for investors to participate in. So there's real competition these days for equities. This is, we think, a whole hum year for many asset classes after a horrendous year. Not liftoff yet this year.
What would you look for in the equity space?
Well, we love China still. We've been on that bandwagon for a bit now because, their economy is accelerating as the year goes on. Their profits are accelerating as the year goes on. Their central bank is relaxed, not hitting any brakes, even as the year goes on. That's in stark contrast with what we see elsewhere. And it's still a very inexpensive market. People say, well, look what it's bounced off the bottom. Yes, but it's still only 11 times earnings, and the earnings are going to be accelerating. So that's really great. Longer duration growth stocks, the United States, they're not off to the races, but it's been a long, long time since you could buy things like cyber or cloud at reasonable prices, and they still have explosive growth.
Yeah. What has the time passed for alternatives and credit?
Well, if alternatives you mean privates, the time will never pass. There'll always be. But, things like private equity, public equity all termed out their debt. Private equity, the debt behind that is almost all floating. It's in private credit. So as those float up, that chokes a lot of the profits, and they never were marked down yet in valuations. So has the time passed? Well, there'll always be opportunities, but the time is not now for those. For credit, you said, is,
right.
Again, depends where you go for credit. Usually when you're at is the Fed close to peak rates, you do want to start looking overseas. The flight to safety starts ending and people go overseas. You can find better credit opportunities overseas than here.
And speaking of overseas, what about the fixed income market, domestic and emerging market?
Well, this year we like most overseas, China the most,
right.
But there's still opportunities like China property bonds, huge gains, but there's still money good, really top quality instruments that you make double digits with in credit. It's better than you'll get in U.S. high yield. In a lot of emerging markets, in their local currencies, as the dollar comes down, that's a wind at their back, and those yields are still, those central banks took rates higher much earlier than our own. They're ready to have a disinflationary wave that's probably bigger than our own, and they'll have a currency wave. Here, we're not going to see rates once they hit 5 go back to 1.
Right.
You may see them go back to 3 or 4. In the emerging markets, those central banks really took rates up, and they can really start bringing them down, and you'll get a currency wave.
Well, and speaking of bringing rates back down, I think the Fed is telegraphing pretty clearly that it's not going to make a massive pivot shift or move too fast.
That's right.
Not wanting to repeat what we saw, 40 years ago. And it almost feels as if the market's fighting that.
Yeah, the market says, look, we've seen this movie before. You always try to jawbone us, but we do think this time is different. Mm-hmm. We've had 40 years of a disinflationary tailwind, megatrends, and many of those megatrends are reversing. And so, the biggest issue is central banks used to grow their balance sheets plus or minus nominal GDP. The last dozen years, nominal GDP in the United States doubled.
Right.
Their balance sheet went up 11 times. We have to clean up that mess to a large degree. So this time, we really don't think they're bluffing. And the issue is not, do they cut rates 100 basis points? Who cares? It's, do they keep QT going and going and going and going? Because that impacts markets more than interest rates. Interest rates impact the economy and markets, but the economy more, markets less. In our view, QE, QT impacts the economy a little bit, markets a lot.
Right. Well, it's a great point that you make, that the markets and economy are, at the end of the day, two, in fact, very different things. And of course, you have a generation of investors who have never experienced what you could even argue this is more normal of a market than what we've seen over the past 10, 12 years, where it only went in one direction. And the velocity of the moves was remarkable.
Well, we'd say instead of 10 or 12, 10 or 12 capped off a 40-year disinflation wave.
Right.
Disinflation, the expansions lengthened, the recessionary periods shortened, and the downdraft became more shallow. If you go prior to that, it was just the opposite. And we think these mega trends that are reversing are going to make this slow period that we're going into much longer. The profit downdraft, given the slow period we go through, deeper than most expect. And if you're withdrawing liquidity as those cash flows slow, well, that's what markets are all about, cash flow and liquidity. And they're both going in the wrong direction in the United States this year. They're going the right direction in China. We'll go to China this year.
All right, Michael, we appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.